All right, in 5 minutes or less, I'm going to try and explain why I'm short-term bearish from an institutional slash hedge fund point of view. I will note I am bullish for 2026, so this is a short-term view, my bearishness. So let's get right into it. For context, on Thursday we had a sell-off, sharp sell-off, retested 6,800, but Friday and today, Monday, we sort of bounced back and bulls took control again like nothing ever happened. So at the surface level, it looks like the worst is behind us, but from an institutional perspective, we always want to be looking at what's going on under the hood, right? The main question we're trying to answer is who was buying this rally, this dip? Was it accumulators or was it being driven by systematic rebalancing, right? And this matters because accumulators are your funds, your real money, your active buyers, right? When they buy, it's a durable bid. There's follow through. If the composition of your bounce or dip buyback is mainly accumulators, that's a good sign that it'll stick. Whereas if your rally is mainly from being driven by systematic rebalancing, vol control funds, CTAs, that's more temporary. Their marginal bid doesn't mean as much because it could go away. It's based off triggers. They're not even, they might be just chasing gamma. It's not really real, right? And so, spoiler alert, it looks like Friday's rally was driven by systematics, okay? And there's a few ways we can tell. So first of all, skew repriced higher on Friday, right? So that tells us that demand for puts rose relative to demand for calls. And that's not what you should be seeing when the market rallies 2%. According to the vol signals guys, which I follow, the last time that happened where you had a case where the market rallied significantly but skew repriced higher was October 2022. And 5 days later, the market was down 5%, right? So maybe there's a case to be made that, sophisticated traders saw that this was a mechanically driven rally and took the opportunity to get additional downside protection. But at minimum, it's just not what you want to see in a real bottom, right? Because if this was a genuine shift in fundamental sentiment, you would see put holders closing out their downside hedges, because they would effectively be saying, okay, the worst is over. We don't need these puts anymore. And that didn't happen, right? Secondly, there's a case to be made that the sharp rally on Friday was just driven by negative gamma. So markets opened in a firmly negative, it's a neutral to negative gamma territory, which does accelerate and amplify moves, makes them more violent and sharp, which we saw. I know this is still technically neutral to positive gamma, but the whole week, gamma had sat around 5 to 10 billion. And when you go from that to around, less than a billion in gamma, that's as good as negative gamma, right? So we saw that. So another reason, maybe this rally wasn't as sharp because people believed in the dip. It could have just been reflexive, right? So that's a sign there. Additionally, you have the VIX is already pretty low, so there's not much vol that can be sold to push the index higher. What I mean by that is that, a lot of CTA and vol control funds buy the index as vol goes down. If vol's already low, they're already stretched, right? Actually, according to Bank of America, they're already in the 90th percentile for exposure, these CTAs. So they're already mega long. I think it says here, yeah, they're max long. So where's the juice going to come from to make new highs and keep going? Where's the marginal bid going to come from? We also have a big liquidity drain this week from Treasury auctions. Jobs and CPI get released Wednesday and Thursday. That's going to ensure the markets are quiet until Wednesday and Thursday as institutions are in wait and see mode. And then, applied vol might pick up, usually just picks up when on big releases like that. And the main reason, well, not the main reason, but another sort of nail in the coffin, which could skew risk lower this week, is the CTAs, which are projected to sell. There's going to be a lot of systematic flow for sale this week. to the tune of billions in every tape. So whether the market's flat, whether it goes up or whether it goes down, systematics are going to be selling flow. So that doesn't hold well, because if you need a real bid to counteract that, right? And given the markets are already at all-time highs or near them, given that CTAs are already stretched, and given that dip buyers didn't really step in, I don't know where this marginal bid is going to come from to just take us, further. If anything, at least be cautious around here, and it's just not a good time to add. If you're more adventurous and risk taking, you could open up a short position, because it is asymmetric to the downside right now. But I would wait to see what happens Wednesday and Thursday and trade the fallout from that. And know that if we start taking out these levels, especially Thursday's low, there's already projected to be a lot of systematics selling, right? And that's going to be even more true if we start taking out some of these triggers. So just be careful. We're not out of, at minimum, we're not out of the woodworks. This is how a trader thinks. They got to take together information, not make predictions, but say, okay, what's the path of least resistance, right? And there's a lot of resistance for us to keep going higher for reasons mentioned, and there could be a trap door beneath us. So let's react and take it day by day and see where we go from here. Thanks, guys.